Yeah, so just want to first of all welcome everyone. And if we haven't met before, my name is Shannon and I'm part of the community engagement and events team at Russell Alexander Collaborative Family Lawyers. We want to thank all of you very much for joining us today for Family Law Now Live's presentation on divorce and business valuations advanced topics. This presentation is an extension of part one of the series that Russell, Melanie, and Jason hosted in February of this year. So I'm just going to start with a bit of housekeeping and introductions, and I'll let you know what's on the agenda today before passing things over to our lovely panelists. As we are presenting virtually today, we do apologize in advance for any technical issues that may come up. Once I pass things over to our presenters, I'll be available behind the scenes for any questions or tech issues. So if you are having any challenges throughout the webinar, please feel free to contact me at shannon@russellalexander.com, and I'll do my best to help resolve the issue. So in this 1 hour presentation, Russell, Melanie, and Jason will be discussing advanced topics in divorce and business valuations, covering the following topics. We'll be doing a quick review of the first presentation, business valuations, tips, tricks, and best practices, followed by common valuation approaches, scope limitations, cryptocurrency, redundancies, value of shareholder and related party loans, personal expenses and other common normalization adjustments to consider in a business valuation, the difference between personal and commercial goodwill, notional disposition costs, market economic compensation, double dipping, and our panelists will also be offering their top 5 tips to reviewing and critiquing a business value report. We'll also have a Q&A portion at the end of the webinar, so if you haven't already, please feel free to submit your questions via the Q&A box, and we'll do our best to get to your question during the presentation.
Wow,
And just a quick note that we have
that's a big agenda.
have a lot to
We're
cover
talking
today.
about all that in 1 hour.
Yeah, it's all going to happen in 1 hour plus some questions.
Okay. Sorry, go ahead. Let's get moving.
So like Russ said, we have a lot on the agenda today, but we are going to do our best to get to as many of our audience questions as we can throughout. You'll notice that the chat function has been disabled, and this is just to allow everyone to however you can submit those questions through the Q&A box. We also just ask that you keep in mind that the content of this webinar is to provide you with general information, and it should not be considered as legal advice. We'll also be providing links to additional resources in a follow-up email tomorrow, so keep an eye out for that. So without further ado, it's now my pleasure to introduce today's hosts. We have Melanie Russell, Jason Kwiatkowski, and Russell Alexander. So Melanie is the founder of Calyx Valuations Incorporated, which she founded in 1996. Throughout her professional career, she has been involved in many assignments for a variety of public and private companies of various sizes and across many industries, obtaining her training at 2 of the largest international accounting firms in the industry. Melanie placed second in Canada on the CICBV membership examination. Ms. Russell has been active in teaching business valuations and related topics since 1987 at various universities and professional organizations, and runs the premier preparatory course for CBV students in Canada taking their national membership qualification examination. Jason is a founding partner and the president at Valuation Support Partners Limited, a professional services firm specializing in providing the business and legal communities with business valuation, litigation support, and exit planning advisory services. Jason is an independent financial neutral and has completed numerous business valuation and expert reports, including income assessments for various purposes. Jason has testified before the Ontario Superior Court of Justice as an expert witness in business valuation and damages quantification. And Jason has also authored many articles and spoken before various professional and business groups. Next, we have Russell. And Russell is the founder and senior partner of Russell Alexander Collaborative Family Lawyers. With over 20 years of experience, Russell offers a wealth of knowledge and expertise in collaborative family law. He uses his experience with a client-focused approach by creating unique solutions for each of his clients to enable them and their families to move forward with their lives in a compassionate and collaborative manner. Without further ado, I'm going to now pass things over to Russell to get started with the presentation.
All right, let's make a start. Thank you so much. Let's put up our first poll. And while we're the first poll question of today, and we've got some questions that came in ahead of time. Thank you. Put your questions in the chat box. We're going to get to as many questions as we can. In your experience, what is the most commonly disputed area of valuation in family law matters? Normalization of adjustments, cash flow, redundant assets or liabilities, earning multiples, valuation approach, contingent disposition costs, or all of the above. So we're going to give everybody a moment to consider this poll question. In the meantime, just want to say, please provide us with your feedback at the end of today's program. We have a book, I think. Do we have a quick of the book, Shannon? Can we throw it up there? We have our ebook that we produce, which is the 101 series. That's the first series we did in this program. So Shannon's going to give you some information how you can get a free copy of this ebook at the end of today's program. Again, provide us with your feedback, answer the polls. We'll make it much more interactive. We really appreciate everybody's input. And this course is 201, so we're going to assume you have a certain knowledge of business valuations. We're going to take a much deeper dive today into this issue. Let's take a look at our poll results. And what do we got? Normalization, 5%, cash flow, 13%. Looks like valuation approach, 18%. All of the above, 49%. So thank you for answering those poll questions, everyone. And just a reminder, we're just going to do a quick review of our 101 session. So this is going to be a few minutes, and then we're going to take a deeper dive. So in 101, we talked about what is a business valuation, when a valuation is required, costs, benefits, risks, and pitfall. How can two experts come up with two different valuations? Assumptions that the experts are making, why the court likes experts to hot tub when there is a difference, and tips and tricks for business owners, spouses, and lawyers. So you can get all that in the book that we've produced. That's going to be give you information on how you can get that at the end of today's program. Another quick poll, and then we're going to get into the substance of everything we're talking about here today. So poll number 2, what is the most common valuation report that you see? So I'm assuming we've got a lot of professionals, a lot of experts in our audience today. Is it the calculation, the estimate, comprehensive, limited critique report, or none of the above? So we'll give everybody a moment to get your answers in. And I'm going to throw a question out to Melanie while we're waiting for the poll results. Melanie, how long does an evaluation typically take? What would you say?
Excellent question. I guess it partly depends on the type of report you're doing. It depends quite a bit on how easily the information is going to flow. But assuming evaluators get everything all together, which rarely happens, but assuming we do have everything we need, it might take a few weeks.
Oh, I would love to get a report in a few weeks.
That's assuming you guys have already helped us out by getting a few
weeks once you get the information for you to turn it around. But getting the information could take months, right? Depending if you're waiting on third parties and
exactly.
Let's see what our audience says about the most common valuation report they see. Let's see what our poll results are. So calculation about 32%, estimate 28%, comprehensive 22%, limited critique report 13%, none of the above 5%. So fairly varied response. So common valuation approaches. Jason, what should we expect here?
Yeah, this is a good place to start, I think, with the session, talking about just the general valuation approaches. I think the first question that you have to ask as a valuator is, what is the basis of value you're going to use to value the business? Because a business can be seen as a going concern, which is, assuming the business is going to continue to operate going forward, or it can be seen as a liquidation type of a scenario. If liquidation of the business is likely or being contemplated or expected, then you have to value the business on a liquidation basis. If it's a liquidation basis, which from my perspective and experience is not very common, there's two sort of assumptions, underlying assumptions or approaches. in a liquidation scenario. One is an orderly liquidation, in which, you know, the business is being liquidated over time to allow the maximum proceeds to be received on the liquidation of the assets. The other assumption or approach is a forced liquidation. That's like an immediate liquidation. The company's forced to liquidate all its assets, pay all its liabilities, and be done with it. In that situation, there may be some more discounted asset values and lower value, but those are the two liquidation scenarios you're seeing. Like I said, not very common. The more common situation that we're all going to see and deal with is the going concern business. So once we've established we're valuing the business under a going concern basis, there's three different approaches, general approaches. And this may be a review for everyone, but you're going to be looking at a cost approach, an income approach, or a market approach. So let's just talk briefly about each of those. The cost approach is really a balance sheet approach. What you're doing is you're looking at the balance sheet and you're adjusting all of the assets and liabilities from their book values to market values. So it's called an adjusted book value approach. That's the most common cost approach. Companies that are valued under this approach are primarily real estate holding companies, investment holding companies, companies where the value is driven largely by the value of the assets. It could also be looking at a situation where you have an operating business, but its assets are not generating a sufficient return to justify any goodwill, so you're going to use the cost approach, the balance sheet approach. The second approach is the income approach. This is the most common approach you're going to see, and there are different variations. Capitalized earnings, capitalized cash flow, discounted cash flow. Ultimately, the concept is the value is a function of the present value of the future earnings or cash flow stream of the business. So you're capitalizing an annual maintainable earnings stream, or a valuation multiplier is applied to that value stream to come up with a lump sum value. Okay. The third approach is the market approach. And the idea here is that you're using multiples from either comparable public companies or comparable industry transactions to estimate the value of a target business. So in simplistic terms, the idea is that if you see that another company was acquired in your industry for 4 times EBITDA, then maybe your company, the target company, is worth 4 times EBITDA, and that's how you'd value it. Typically, I do not use or see this approach being used as a primary approach. It's more of an approach used to sort of verify the reasonableness under another valuation approach. And that's because there's some issues with using this approach. You're not always going to find a truly comparable company, whether it's a public company or another company in the industry. So it's very difficult to use this, rely on this as a primary approach.
Great stuff. Thank you, Jason. We had a question that came in online asking this, if this is credited for 1 hour of professionalism. We've submitted an application for CPD accreditation with the Law Society. I think because of the summer holiday schedule, we don't have an answer back, but if it is accredited, we're going to notify everybody. So keep sending your questions in. So scope limitations. Melanie, what should we be looking at here?
So scope limitations, just to back up as to what they are, evaluator has certain obligations to put into their reports. So one of the obligations is to list the scope of review. So what did you do? What did you look at? And if there are any scope limitations, for example, the infamous, we've requested something 300 times and still has not been received, or it doesn't exist, then the evaluator needs to put into the report that they requested but were not provided with these documents, and also put a comment as to what they expect the implication will be. Now, most of the time I find if you can't get certain documents, you don't know what the implication is. So it'll be, well, we've requested these documents, they weren't provided, we can't comment on the impact, if any, that this would have on our valuation. So the issue with scope limitations are that, you know, the evaluators really are saying that we would like to have had this to really provide our conclusion. We'd like to have had this. It may or may not be significant, but it's not enough to say that we can't do the report. We can still do the report, but just tell the reader that we haven't been able to get these items and we're not sure of the impact. So the scope limitations can be significant. They may not be significant. And the reality is that, evaluators want to get a lot of information because what we're really doing is a mini diligence, as if we were advising a purchaser of this company or advising the vendor of this company what the offer price should be. So therefore, we need certain information to do that. But sometimes it's impossible to get certain information. The documentation may not exist. And if you think of marriage date valuations, they're just, the information may not be around. So it may no longer exist, or it may be very difficult and very costly to obtain. It just may not be accessible or easily accessible. And an example of that is multiple shareholdings of a business and the other shareholders aren't willing to provide details, especially if it's a small interest, 1%, 2%, 10%, it may be very challenging to get that information. And of course, it may be a case that if the party is just not disclosing, is not willing to disclose. So it could be various reasons, some nefarious, some not nefarious, some just the way it is. So we just need to disclose upfront and let everyone know what we weren't able to obtain, that we would have liked to obtain, and what the impact might be. Sometimes these scope limitations will give rise to the need to do more than one scenario on a particular issue. So if there's something that we can't get or isn't available or easily available, then maybe evaluators might be able to deal with it by saying, well, if this is the case, then here's what the value conclusion would be. But if this is the case, here's what the value conclusion would be.
All right.
So
that kind of leads, let's talk a little bit next about redundancies. I think you're going to talk about this one, Jason. Or sorry, we're going on to cryptocurrency next, but before we get to that, did you want to add anything, Jason, to scope limitations?
No, I think that was good.
Yeah,
we covered it.
All right, well, this is a hot topic. Our next one, cryptocurrencies, like the floor is this thing's fallen, what, 56% in the last 3 months, and everybody thought they're going to be millionaires, and some of them were millionaires. I don't know if they still are. What are we doing with cryptocurrency here, Melanie? Like, is this craziness or what?
It's craziness. And, if you've been around, Jason's probably been around long enough too, you've seen these cycles of things that are hot for a while and maybe not so hot. I can still remember .com era and all that. So who knows, if you listen to any experts on cryptocurrency, no one really knows where this is headed. Is this going to be adopted by the world and that's all we're going to use? I doubt it, but some countries are starting to use this. So who knows where this is headed? From a valuation perspective, I think the main issue that I see, main issues, is one, being able to actually find it or trace it, figure out what someone owns or what a business owns in terms of cryptocurrency. And then the valuation issue. And the valuation issue probably isn't as significant, but it's, cryptocurrency is, as you know, very, very speculative stock or speculative asset. So pinpointing what the right value is at a point in time may be a bit of a challenge, but I think the bigger issue is sometimes just finding out what is owned.
Yeah, I've heard studies. Well, Warren Buffett's not a fan of crypto, right? Some people think it's going to get to $6 million a coin if it becomes, more established, and they've got a chart for everything. But is it like we're looking at a weather report? What was the weather like on the date of separation? And then, okay, well, crypto was trading for X. Can we get that kind of data from, the stock markets or the crypto indexes?
You certainly can. I would say that, I'm in the Bahamas. I looked at the temperature here, the forecast, and it's basically 28 every day and 27 every night. So fairly predictable, but crypto is not at all like that. So I think it is. You can actually get the values because there are places that trade the cryptocurrency, so you can access that once you know or are able to find out what is actually owned and pinpoint the valuation dates that are relevant.
And what about NFTs? Have you dealt with these yet? What are they, fungible assets? People selling digital images, and they think the potential value is going to be $1 million, but like, how do you value these things?
That's way harder because there's not really, as far as I know, and I haven't dealt with them, to be very, very open, I have not dealt with the NFTs. So those would be much harder to value because there isn't an established market for them.
Right. Jason, what do you think of all this?
Yeah, that's a good question. I am by no means a cryptocurrency expert or an NFT. I haven't dealt with valuing NFTs or cryptocurrency. Cryptocurrency, I know, has a public, like a publicly traded value, like another currency, a dollar currency, but it's just subject to so much market fluctuation and risk. And yeah.
Well, if you valued it in January, right, whoever held that asset, it's now down 50-60%. It's all right. Well, certainly, I think we're going to see more disputes over this in the future, especially if crypto goes up as high as they think it's going to go. Then the discussion we're having today, do you look at the current value? I guess if it's currency, it'd be current value, but potentially it's got a future value as well. But how do you predict that when doing a valuation? It's almost impossible. So let's talk about redundancies. Jason, this is a little bit more certain topic than cryptocurrency, right?
Yeah, let's shift back to talking about tangible
back to reality.
Assets. Yeah, redundancies. So what do we mean when we say redundancies? Redundancies are really assets, or in some cases liabilities, that are owned by the business, but they're not required for or part of the normal business operations. So if you just think about that, like that's a redundant asset. You have it, but it's not necessarily required for your operations. So some examples are if you have excess cash or marketable securities, maybe you have excess working capital, maybe the business has investments in land or real estate, or maybe there were related party loans, like all of these assets that are not part of the business operations. Those are redundant assets. And the important thing to keep in mind is that in a valuation of a business, redundant assets are valued separately from the business operations and added to the value of the business operations to arrive at the total enterprise value. Okay. And this is something that we deal with on every valuation. This is very common. It's very common for companies to have redundant assets. So I think if you are working with a business valuator or reviewing a business valuation report, I think take a look at the balance sheet at the valuation date to see if there could be any assets that are not required for business operations, and make sure that they've been valued separately and included in the value. Another thing, it's not as common, but there is such a thing as a negative redundancy. That's things like if, let's say, your working capital is below water, you have a negative working capital, and the business requires a working capital injection. That can be considered a negative redundancy, which comes off the value. One final point on this topic to keep in mind is if there are redundant assets in the business, think about and look at if there's any income that's being generated from those redundant assets that are part of the income statement. Because any income that's generated from those redundant assets, that needs to be normalized or taken into consideration when you're valuing the business operations. We're going to talk about normalization adjustments later, but that's one thing to keep in mind.
Excellent. Anything you want to add to redundancies, Melanie?
Yeah, I would just say some of the redundancies are obvious and some are not so obvious. And it's the way I like to think of it is if someone was coming to look at buying this business, they would say, what do I need as soon as we close to go and generate the cash flows that we're paying for, and then what's left over, and that really accrues positively or negatively to the owner. So if anyone's ever seen a purchase and sale agreement, they usually have what we call a working capital peg, And that's an example of trying to figure out what the balance sheet should look like at closing. So the working capital should be 1.5, and if on closing, or in this case, the valuation date, it isn't, if it's higher, then there's a higher purchase price paid to the vendor, and if it's lower, then that reduces the purchase price. So you have to, and there's a lot of different hidden types of redundancies that mean you have to sometimes dig, like can be shareholders' vehicles, or the kids have vehicles, or excess pieces of equipment that are sitting there. They've been sitting there for years in the plant, not being used, but they could be sold for something they just haven't been.
Great, great to know. All right, let's run a poll, because we haven't done a poll for a little while. And our next poll is, what spaces of value do you think courts follow most often in family law matters? So, or sorry, is this the right one? Yeah, here we go. What's the basis of value? That Shannon's tricking me here. So we got the right poll. Value to owner, fair market value, equitable value, none of the above. And while we're waiting for people, this cryptocurrency has got our audience excited. So I'm not sure we're able to answer some of these questions. So one is, how people have lost money via cryptocurrency. I'm not sure if I understand that question. I guess technically you're not losing anything until you sell it, but I guess it's the value on the books. Is it possible to have an online business revenue and expenses through cryptocurrency? The value of the business that uses cryptocurrency is primary current. So if you have a business that all they do is cryptocurrency, can you value that business? And what are you going to do? Use what it's trading for on that particular date of valuation, the separation date? What do you think, Melanie?
That's an interesting question. I mean, it might be similar to if you have a day trader, same idea. Is there really any value over and above what the securities are worth at that time? So I would, I'd obviously have to look at the situation, but I would expect you'd probably just be valuing it based on what is owned at that date and what the value is at that date. And one other thing just to think about with crypto is that there are tax rules there's existing tax rules, and some people may be following them and may not be following with their cryptocurrency. So you may end up in a situation where there are some tax liabilities or contingent tax liabilities related to crypto to watch out for.
All right, Jason, you want to add to that?
No, I think those are some good points. I mean, if a company is dealing in cryptocurrency akin to a day trader, I don't know how big that company is. It could be one person just speculating and making trades, like could be a personal goodwill type situation. And we're going to talk about that later too.
Was an online company, and I guess their crypto is, I guess, the form of payment they accept.
Oh,
okay. One more quick question, and then we're going to get to the poll results. I'm not going to name names, but a senior, well-respected family lawyer in Toronto is asking to you, Jason, why would we exclude redundant assets from evaluation if the business would be notionally sold with such a redundant asset? So I guess the question here is, well, it's going to affect the business, right? But what if you're not selling it? I guess is what you would include.
Sorry, just so I understand, was the question, why would we exclude redundant assets?
Why would you exclude redundant assets from evaluation if the business would notionally be sold with such a redundant asset?
Yeah, sorry, I may have miscommunicated, but I wasn't trying to imply that we exclude redundant assets as part of the valuation. They are included in the value of the business. They are just valued separately from the business operations and then added to the value of the business operations. So they still do form part of the value of the shares of the business.
Okay, thanks for clarifying that. Let's see our poll results. All right, well, fair market value appears to be what courts is following according to our audience. So I guess that's sort of akin to, you've got your furniture and your contents of your home. And I have clients say, I bought this couch for $2,000 from the brick, right? And, your couch with a stain on it might only get $100 on the side of the road. So you're not going to use the purchase value. So I guess that's sort of where our audience is at. At least that's my spin on it. Let's get to value of shareholder and related party loans. Melanie, can you take this one?
Sure. So as was just said about value shareholder redundant assets, related party loans and shareholder loans may be considered to be redundant. So it may come into that bucket that Jason was talking about. But there are other considerations on the shareholder loans and related party loans. So shareholder loans, as you may have heard, can result in some tax implications, because the general tax rules say that a shareholder can't borrow from the company and not pay it back. If they don't, then it has to be included in income. So at a certain point in time, if that shareholder loan has been outstanding for more than a year, then in theory it comes into their income. So there's a correlation between shareholder loans and income. So one of the things when you're looking at valuing that shareholder loan, which would, if it's due from the individual, it goes on the debts and other liabilities section. If it's due from the company to the individual, it would go as a receivable, as an asset on their personal financial statement. But if it's a payable, then you have to think about, well, hold on, should that full amount of that loan due to the company be added as a liability on the financial statement, or should it only be the tax portion? Because if it's not paid back next year, it's going to be added into the tax return, line 15,000, and there'll be the liability really is the tax, and it's not repaid to the company. But then that can get into double taxation with the company. So you have to really consider how that's going to be treated. So the value may be the face value, or it may be something else. So you have to take a look at that and make sure you're not double counting with income. Another, on the related party balances, again, they might be between companies or between sister companies or a holding company or family company. If those loans, if it's sort of 100% owned by the individual who you're valuing their property, all the companies are 100% owned, it really doesn't make much of a difference. The issue might arise if it's not all wholly owned by one individual. So it may be possible that one company can't repay, or realistically isn't going to repay it in reasonable time. So you might have to get into revaluing one of the loans. One of the practical consideration, which it's a valuation issue, but it's more of an accounting issue that is pretty common in my experience, is that the related party or intercompany balances may not match. Sometimes companies use different accountants, and sometimes accountants can't reconcile something because they may be new and it was never reconciled in the past. So there may be an issue if there's not a reconciliation among the companies with the related party balances.
Jason, you want to add anything?
I think that was all good. I think the only thing I would add to that is this can be a difficult issue to address in complex matters where there's like a complex org structure and there may be a number of different companies in the group, and maybe different companies have different fiscal year ends. I've seen situations where companies are loaning, advancing funds back and forth and valuing them at different dates and matching them up and getting into the general ledger to try to make sure they agree one side versus the other. It can be a complicated issue to deal with.
All the more reason to hire experts. Let's do a poll, because it's the only thing I get to talk about. You guys are way over my head on these issues. So poll number 4, let's get our poll question out. What has been your most challenging business valuation issue to deal with? Impact of unreported. So this is for our audience to tell us what they've had the most challenge with. Impact of unreported cash, personal expense, obtaining disclosure, convincing all parties that the report's required, or other. And you can put your other in the chat box and we'll try to get to it. While we're waiting for the results, I think it's Melanie's turn to answer a question. This came in ahead of time. What is the cost of a business valuation? Who pays? So what should people be expecting for one of these reports, and who usually
Well,
pays for it?
that's one of those, it depends kind of.
Yeah, that's a lawyer answer. You're not allowed to use
know,
that
that's
one.
true.
We want answers from you guys.
The evaluators learned it from the lawyers. So
Oh, okay.
it's a tough one to answer, because I can say in my experience, and Jason may have a different experience, but you can some valuations can be done very quickly. They're easy companies. They may not require a lot of work. They may not be very contentious. There may not be a lot of valuation issues. So it can be quite reasonably priced. But when you get into situations where there's a lot of contention, there's a lot of difficulty getting information, complex organization structure, as Jason mentioned, counting the statements, financial statements may not be very reliable like that. So we sometimes get into saying, well, hold on, how can we do a valuation if we don't have reliable financial information, because it's sort of garbage in, garbage out. So there may be a lot of consternation and a lot of analysis about how you deal with statements that aren't reliable. So when you get a lot of complexities like that, and then you get, there's going to be other experts, and you're going to be challenged. You got to make sure that it's, it's going to go to court. So it's got to be fully supported, and a lot of work, a lot of research, a lot of market analysis, and that can cost a lot of money. So it can vary significantly, for sure.
All right, let's see our poll results. Thank you for that, Melanie. Unreported cash, 26%. Obtaining disclosure. Yeah, that's difficult when it's third parties that you can't really forced to produce disclosure unless you get a court order requiring them to. And it's a difficult situation when you're doing collaborative files as well. Convincing people that have reports required. So fairly unreported cash and obtaining disclosure seems to be the big pain points for our audience members. Thank you for everybody for sending your selection in. All right, so other expenses and other common normalization adjustments to consider in a business valuation. Jason, can you take this one?
Yeah, normalization adjustments. What are we talking about with normalization adjustments? So normalization adjustments are required when we're using a capitalized earnings or a capitalized cash flow income approach. Remember the approaches we talked about to valuing a business. And that's because in those valuation approaches, we're using the company's historical earnings, over the last 3 to 5 years, in order to predict or forecast what the company will continue to do going forward. So whenever you're looking at past to predict the future, you have to really dig into the past, and you have to identify if there are any items that occurred in the past period that either do not relate to the business operations, or they're not required for the business operations. Those items need to be normalized or adjusted to the historical earnings in order to predict the go forward future. Okay, so it's the normalization adjustments. It's a common procedure that we have to go through in applying those valuation approaches. Some of the most common normalization adjustments that you'll see in a valuation, the biggest one is personal or discretionary expenses. Sometimes business owners will have the business pay for personal meals, entertainment, personal automotive expenses, personal, golf memberships, insured, like all those personal type stuff that's not required for the business. Those are personal items. They need to be added back or adjusted or normalized when you're looking at the historical earnings. Other items are like salaries, wages to the shareholders and related parties. We all know shareholders sometimes take excess salaries or bonuses to bring down the corporate income. Sometimes they won't pay themselves any salary or wage. Maybe they'll pay themselves a dividend. Sometimes they may pay family members that are not even involved in the business. You have to look into those payments to the shareholders and the related parties, and you have to normalize the salaries to an economic or a market amount that you'd have to pay a third party to do the same role position at the business. Another common normalization adjustment is rent expense, especially if the building or the premises that you're operating out of is owned by a related company. You have to look and make sure that the rent expense being paid is at market rates. And then another more common normalization adjustment is anything that has happened in the past that's non-recurring, a one-time item. Like if there was a loss or gain on a sale of a capital asset, maybe there was a large one-time repair and maintenance expense. Maybe there were some professional fees that, you know, were one-time items for tax planning, or there was a litigation going on in the past. Or maybe you had a computer system changeover and there's a one-time installation cost. Like those types of one-time things need to be normalized in the historical period.
Great stuff. Melanie, anything you want to add?
Yeah, I think just thinking about that was a great summary, a great commentary. One thing's on the normalization adjustments. The reason evaluators have to do them is because we may not be given projections, or if we're given projections, we are trying to assess the reasonability of those. So I subscribe to that view that the past is irrelevant if it's not going to recur, but we always look at the past and try to assess whether it will recur or not. So these normalization adjustments are made to try to say, if those years happened again in the future, what would they look like? So it's really a way to come up with projections and try to use our crystal ball to the best we possibly can.
Great analysis. Thank you both. All right, let's do a poll. Final poll of the day. So everybody, sorry, I made a mistake earlier. You put your other answers in the Q&A. I said chat mistakenly, and somebody notified me that that has been disabled. So other answers go in the Q&A. Today, the final poll: what valuation multiple should be applied to a company's earning to determine its value? It's always a big area of dispute amongst lawyers. Certainly be interesting to see what our audience thinks. And while we're waiting for those poll results, I've got a question for, I think Melanie's up next. Do joint retainers, or sorry, this is Jason. Do joint retainers really save costs?
Yeah.
That's the idea, right?
You
Do
know,
a joint retainer.
that's the idea.
Right.
The idea is that if we only get one evaluator involved here to work for both of us, we'll save half the cost.
Why do we have to pay for you guys or girls, right? Yeah.
Yeah, I mean, in theory, it may seem that way. And I have had a couple of cases where you have reasonable, honest, forthcoming parties. And in that situation, you can save costs. But I've also had many more joint files where the parties are so opposed on various issues, like unreported cash or personal expenses or other issues. They have different stories, they have different opinions, and they're very far apart. And you get into the situation where you listen to both of them and you have to follow up, and you're doing repeated work, and it's drawing out the process, and it can end up costing a lot more. So
Yeah.
it doesn't always save time and money.
Yeah, Melanie, your take on joint retainers?
Yeah, I totally agree. I think when joint retainers started being popular, I thought I was very naive and thought this is an amazing idea. What better way to ensure you get rid of the what I call disclosure hell? Because both parties are going to, if you're working for both parties, everyone's going to disclose. And what a great way to make sure that everyone comes up with a very fair number. But I totally agree with Jason. Sometimes they work, sometimes they don't. And I think you have to, they could still work when the parties are one's maybe more financially sophisticated, and maybe one's more, one doesn't necessarily have access to the information. But the person that is less financially sophisticated, they may need to have an advisor or an ear on their own, just to run things by, so that it, maybe you can still use a joint, but there's a financial advisor, evaluator, whatever, helping out the person that is maybe on what is seen as the weaker end financially.
Yeah, in my experience, I think it's effective for collaborative files. Like we had a collaborative case with a joint retainer. My client thought husband was earning cash sales, was running personal expenses through the business, which he was. And so our expert was able to go through all those and address their concerns. and it worked out quite well in a collaborative setting. I'm getting told to move on because our poll results are up. Depends on the industry. All right, so so the question is multiple. So it depends on the industry. I don't know. No clue. Get a certified business evaluator involved. That's actually a pretty good answer. And we're going to talk about this. So the difference between goodwill, personal and commercial goodwill. Jason, what do we need to know here?
Yeah, I'm actually glad and encouraged that nobody selected 4 to 5 on that last poll. That's the multiple. Anyways,
That is the answer?
as the answer, yeah.
Okay.
Anyways, personal versus commercial goodwill. So commercial goodwill is really the intangible value of a business that's transferable to new owners. Whereas personal goodwill is really specific to the unique skills, attributes, involvement of the shareholder. Okay, personal goodwill is not transferable to another owner, and it has no commercial value. So no one's going to pay for personal goodwill, because once that shareholder who's running the business is no longer involved in the business doesn't exist. Like, the customers, the clients will not transition to the new owners. So that's ultimately what we're talking about here. I guess to illustrate, it's nice to think about the extreme situation. So if you have, think of a large, stable manufacturing company. It's got 10 million in annual revenue. It has customer relationships and contracts. It's got a workforce of 40 employees and an experienced management team, a good reputation. There's a situation where there's obviously some commercial goodwill if this is a profitable business. Then contrast that with a small personal service business. It could be a sole proprietorship, one person, under 200,000 in annual revenue, maybe only one employee, the shareholder, perhaps an assistant, no customer contracts at all. It's all personal relationships. It requires the owner's involvement in the business, and maybe even the shareholder's name is the name of the business as well. Well, that's a good clue or tip that you might have a situation where there's personal goodwill here and
Sounds
no
like
commercial value.
You're describing a small law firm there, potentially.
Yeah.
Yeah. Great examples. Anything you want to add on this topic, Melanie?
Yeah, one thing I'd add is that this isn't a hard and fast thing. So yeah, there's those extreme examples, but then most of the time it's somewhere in between. And I like, and you have to remember you're imposing normal commercial terms. So as in if there was an actual purchase or sale of this business. So the presumption is that the owner is going to sign a non-compete, non-solicitation, and will be around to transition the business. So that's where you get into the softer area that, maybe if this person just took off and moved to the Bahamas and no longer had any involvement with the employees, the suppliers, the customers, then yeah, maybe there's not a lot of value. But the reality is, the assumption is that someone's not going to go to the Bahamas unless they have transitioned the business, maximize their purchase price. So they're going to do whatever it takes to maximize that, and they will cooperate. So it sometimes gets into very gray areas.
Excellent. So I want to leave some time for Q&A. Let's get into notional disposition costs. We covered this in 101, so we don't need the basics. But Jason, what are some advanced things, maybe 2 minutes or less, that we should be mindful of with respect to notional disposition costs?
Yeah, so assuming we all understand that if you have the value of a business asset on the NFP statement, you're allowed to take a deduction or a liability for the future disposition costs or income taxes that will be incurred on the ultimate sale of the business. Okay, so we all understand that. So what are some issues to consider? Well, I think, you want to consider whether or not that future sale is going to be a sale of the net assets of the business or the shares of the business, because it triggers different tax consequences. You want to consider the timing. When will the asset be disposed of? Because presumably, unless, proceeds are needed to fund an equalization payment immediately, you're not going to dispose of this business in the very near future. It may not be disposed of until retirement age or death at some point in the future. So timing is important, because if you're not going to incur the liability today, not until some point in the future, then you need to take some type of a discount or present valuing to those disposition costs. And then the other issue is, when you're calculating the taxes, what tax rate are you going to use? Are you going to use the highest marginal tax rate? Well, I think it depends on, what the individual's other income is going to be at that time. What tax bracket are they in? And if they sell the net assets of the business and distribute funds by way of dividend, they can do that over time to minimize taxes. So tax rate is also another issue you got to think about.
Great tips. My advanced tip on notional disposition costs: consider applying them to date of marriage assets. Market and economic compensation. 2 minutes or less, Melanie. Advanced
Okay, so
tips here.
This is a normalization adjustment Jason was speaking about, but this is one of the ones that is often very, very sensitive in evaluation. And what I mean by sensitive is the number you pick can have a huge swing on the value conclusion. And it's one of those things I don't think you can just throw away and say, okay, it's 100,000. And particularly as you get into more contentious valuations or valuations that are on the higher level of assurance. So there are various reference points. And so this is really, you've added back what the owner manager has taken, or owner managers have taken out, and then said, well, what is reasonable? So if this business was sold, what would the purchaser pay to an arm's length employee that wasn't a shareholder? And there are lots of reference points for that. Obviously, you always ask the clients and see what they think, what did they earn before, what do they think their industry buddies and friends are earning. You can look at salary studies. You can look, as a reasonability check, I always find out what the next most senior person in the company is earning. That can give you a bit of a reality check. And at the most extreme, and I've had to do this before, engage a compensation specialist, because those numbers can be very significant. I think the important thing is we always use databases, almost always use databases, because you have to ground this, because it makes such a difference. And my experience is, when you talk to someone who has a vested interest in reducing the value, they're going to tell you they're worth $1 gazillion. But if you were talking to that person because you were helping them sell the business, they're going to tell you, you don't have to pay me much. Transition for a couple of weeks and I'm out of here and we're good. So it's one of those areas that's subject to manipulation or bias, and it can have a significant effect. So it also comes into the issue of double dipping, which we'll talk about next.
All right, well, let's get into double dipping. 2 minutes or less. Great summary, Melanie. Thank you.
So what is double dipping? Double counting, whatever you want to call it. It's really the issue of double counting between value or assets, property, and income. And I like to analogize it to the fruit versus the tree. So we think of the fruit, that's the capital asset that we equalize. The fruit is the tree is the capital asset, because I said that right. The tree is a capital asset. The fruit is the income that comes from it. So that's sort of the basic reference point, but it's certainly not a straightforward issue. So the question really is, when we're equalizing property, are we equalizing the particular asset, or are we equalizing just the value of that asset? I'll give you a couple of examples. So stock options, for example, which comes up all the time. So if they're valued at the valuation date, using the market value of the underlying stock at that date, so you say, okay, they're done. Someone may say, well, they're equalized, that's it. We don't ever have to worry about them. But what about if in a few years those options are exercised and the holder sells the underlying shares at a market price that's more than what the market price was at the valuation date? So you'd argue that, well, wait a sec, the income, there's some extra income coming from that. So should that go into the income analysis? And business interests, this is an obvious one with business interests that are valued on a capitalized cash flow or discounted cash flow basis. you are capitalizing the future cash flows, the excess cash flows after paying someone a base return as an employee for services performed. But then when you come to income analysis and you say, well, wait a second, we have to look at the pre-tax corporate income to see whether anything is available to be attributed. In theory, that's arguably a double dipping. So it's definitely not a straightforward issue, and you have to be cognizant of that primarily on spousal issues as opposed to child support issues. So hopefully that was under 2 minutes.
Well, maybe a little bit over, but that's okay. We're going to get into some Q&A in just 1 minute. So top tips to reviewing and critiquing a business evaluator report. Jason, maybe 45 seconds. Give us a couple of your top tips.
Sure, I'll give you 3. The first one is check the credentials of the author. Are they designated? Are they a chartered business evaluator or just an accountant that sort of maybe has some experience in that area? Secondly, look at the conclusions. Are there any scope limitations? Is there anything that the evaluator was not able to do in order to render their conclusion? Because that's something to look into. And the most important one is to really identify the major assumptions underlying the conclusions. What's the normalized earnings level? What's the cap rate or the multiple apply? How did they treat redundant assets? Look at the assumptions, and if you can attack or critique any of the assumptions, then the conclusions are going to change.
Excellent stuff. Thank you, Jason. Melanie, rapid fire, 45 seconds or less,
Okay.
top tips.
Sure. So I would say read the report, make sure you get someone to help you interpret it. Don't just assume that the evaluator is right. It's not that they're not going to be right, but the assumptions, as Jason said, some of the assumptions may not be the appropriate assumptions. So you may have some information that would change some of those assumptions. If possible, have the evaluator meet and explain that report to you, and look at all those. Look at the scope of review. The more stuff that's been covered, the more independent sources have been used, probably the more reliable the conclusion overall.
Thank you. And our host is back. Welcome back, Shannon. You've got some updated information and some Q&A for us.
Yes, absolutely. Just before we get into Q&A, I just want to go over the book that Russ mentioned at the beginning of the presentation. So there'll be a survey that pops up at the end of the webinar. So if you have the time, we welcome and appreciate any feedback you have. And as a sign of our appreciation for those who provide their feedback and a topic suggestion, we'll be providing the complimentary ebook to you. Like I said, we welcome all your feedback. It really helps us grow this series. And just on another note as well, just to remind everyone, I'll be including links to resources in a follow-up email tomorrow. One of those resources that I'll be including is Melanie's book, Understanding Business Valuations Reports, a guide for legal professionals. And this is a great resource if anyone would like to dive in a bit deeper to business valuations. The book is designed to help the reader of a valuation report understand how the value conclusions were developed, assess the reasonableness of those conclusions, and identify common errors. So I'll make sure to include a link so you can learn more if you'd like to look at that. So just before we wrap up here, thank you to everyone who sent in their questions. We hope a lot of them were answered throughout the presentation, but we have time for a couple more here. So question we have is, can economic recessions or crisis affect evaluation?
Who wants to take that one? Jason?
Yeah, of course, market conditions, right? That affects value. Value is constantly changing depending on the circumstances, the market, what's going on at the business. So yes, absolutely.
Great, thank you. I think we have time for one more here. Pretty general question, they said, but is there any recourse if a spouse claims their business is no longer operating or hides its assets?
If a spouse claims no longer well, what's your take on that, Melanie? You're going to have to produce your disclosure, and if the assets show up later, you're obviously going to revisit the settlement that you made. Thoughts, Melanie?
I think that's that's a bit of a legal issue per se.
Yeah.
And how far do you go to find that? That's of course an issue that would be discussed with the lawyers.
family court requires executed financial statements and full disclosure, so you need to comply with the rules. That's my answer. Go ahead, Shannon.
Thank you. We just want to thank everyone again for sending in your questions, and thank you all for your participation today and for joining us. I want to thank our panelists again. A special thank you to our guest speakers, Melanie and Jason. We appreciate you sharing your time and expertise to share your insights today. And we hope everyone has found the content helpful. As I mentioned, we will be sending resources tomorrow if you'd like to take a deeper dive into today's subject. And if you do have any questions about our virtual event series or any comments for our team, please feel free to reach out to me at shannon@russellalexander.com. And there will also be a survey, as I mentioned, that pops up. So if you have the time, please feel free to fill that out. Our next presentation will be on Wednesday, July 27th. We host these bi-weekly, so our next one will be Town Hall for legal professionals and members of the public on presumptive hearings. And I will be including that in the follow-up email as well. So again, we just want to thank everyone, and we hope you have a wonderful day.
Thank you so much, Shannon. Jason, Melanie, thank you for your time.
Thanks for inviting us.
Melanie, enjoy your vacation.
I will. Thank you.
Take care. Have a
Thank
good
you.
afternoon, everyone.